I welcome you all for today's webinar on demystifying UAE corporate tax. It's a new topic and the latest hot topic, and I'm sure the participants must be excited to listen to the speaker. And today I welcome CA Sanjay Agarwal, Sir, Chairman, Direct Access Committee, and Vice Chairman, Sir, CA Piyush Acharji, for the webinar. I also welcome CA Hari Krishnji, Chairman, Dubai Chapter of ICAI, and along with us, we have SP Singh sir, who's today's speaker, and Rishabh Agarwalji, who is also a speaker. So I welcome SP Singh sir. SP Singh sir was with the IRS for more than 2 decades. He held various positions, including Director of Income Tax, International Tax, and CIT appeals. He participated in negotiation of tax treaties with more than 30 countries and took part in mutual agreement procedures. And next we have today's renowned speaker, Rishabh Agarwalji. He is an accomplished CA who achieved an All India rank of 50 in his CA final exams. He is expert in direct tax, international tax, transfer pricing, and FEMA. So I welcome you all. I welcome John sir also in today's webinar. And I hand over to Sanjay Agarwal sir for the opening remarks. Over to you, sir.
Thank you, Shrutika. I welcome on behalf of the Direct Tax Committee to the Chairman of the Dubai chapter, Mr. Hari Kishan Rankawat, our torchbearer there. Then our torchbearer from Abu Dhabi, John sir is here. Then we have SP Singh sir, who's from the side of the committee, is looking after everything. Then we have Rishabh Agarwal, a young speaker in the end. Along with me here from the headquarters, we have just taken a small break from the council meeting. After the due permission, the vice chairman of the committee, Piyush Acharji. So, good evening to in India, in Dubai, and all other countries where somewhere I know it that this program is for the international fraternity, and I'm thankful to both of my Gulf UAE chapters, especially to the chairman of Abu Dhabi and Dubai, that they have taken a lot of effort in getting the things done in their area and getting so much pain they are taking for this implementation. And they every day they welcome guests from India, and they want you can say that their profession to be set up there. So thank you very much that these leaders of the UAE chapter, they are giving the cooperation to the issue. Friends, let me just tell you at the issue of Chartered Accountant Direct Tax Committee this year, we have both international tax and domestic tax. So the international tax, we have just released the background material which we have released in the UAE for those who are attending our certificate course in the UAE corporate tax. However, this particular background, I have been told, and I think the leaders will confirm it in their deliberation, that this has got a lot of, you can say, attraction in the members over there, and a lot of people have downloaded it. It's free of cost. You can download it from the DLH. And also, we are going to launch from India. There is a batch which is going to be online, and the Dubai people have also expressed their desire to launch a physical batch over there. So this is the background. Rest the technical members will speak. And before that, I may request Piyush Bhai to say a few words, and then I will request Chairman Dubai chapter, and thereafter Abu Dhabi, and then SP Singh sir will take over and will brief the participant. Do remain with us till the end, because in the end, the vice chairman will take care of the all question answers, and if anything is left which is unanswered, we'll try to cover it by some way. And that is why do remain with us till the end. Thank you very much. Over to Piyush Bhai.
Good evening, friends. Thank you very much, Chairman Sir, Sanjay Agarwalji, Dubai Chapter Chairman Harkishan Rankawaji, Abu Dhabi Chapter John, the faculty for the day, Senior Faculty SP Singh Sahab. Thank you very much, Singh Sahab, to be available every time, giving a time to this DTC and ICI efforts. Rishabh, a young and dynamic expert in corporate tax and international tax. Thank you very much, Rishabh, for all of you. And all the participants, ladies and gentlemen, it is immense pleasure to be amongst you. And the Direct Tax Committee, as mentioned by the chairman, is now merged. We had two committees as far as the Institute of Chartered Accountants of India is concerned. We had a Direct Tax and International Tax Committee. From this February onwards, in the new council, both the committees have been merged into, and a lot of work has been going on this. Today itself, we have released the background material and for the purpose of UAE certificate course, because a lot of theories were coming. In fact, when we have an international tax course which is concurrently ongoing in India, and the participants from international tax course itself are asking whether you are conducting UAE corporate tax certificate course or not. Yesterday, a lot of questions were there on that. We will be coming with an UAE corporate tax background material has been approved, launched by the president of ICI today in the council meeting. We'll be coming with that particular course. The certain certificate courses, certain members have already completed certificate course. In the last meeting of Direct Tax Committee, we have also approved for the examination to be conducted for those people who have completed those batches. We will be soon, very soon, we'll be announcing those examinations, which will be on the online mode, so that actual certificates can be conferred to those participants who cleared those examinations. With this background, I request you all, please be attentive. It's a very important subject, UAE corporate tax. I've been told, of course, I myself have been told that there are a lot of changes that are happening day in, day out. A lot of clarifications are coming, a lot of decisions, ministerial decisions keeps on coming. So it becomes important for being on this subject. Just for your information, we have today more than 1,000 participants already who have joined, Speaker Sir. That speaks about the importance of this subject. I will come back again in the last 15-20 minutes and try to take all your questions. All the participants are requested. Please put your questions on the link given to you. I think so you would have already given. We are already I'm trying to consolidate them. And I'll try to moderate those and put before the speakers. We will also have Dubai Chapter Chairman available at that moment of time to answer if possible, along with the stalwart speakers. So thank you very much. With this, now I would request Dubai Chapter Chairman Harkishan ji to kindly address the gathering. Thank you.
Hi, thank you, Piyush ji. Are you able to hear me? Yes. I am in the car, so there might be some interruption, but it's fine. So Chairman Sir, Direct Taxes Committee, CS Sanjay Agarwal ji, then Vice Chairman Piyush ji, speakers of the day, and respected members of the chapter. A very good evening to all of you. I welcome each one of you on this today's seminar, Demystifying the UAE Corporate Tax, which is one of the very hottest topic nowadays in the entire GCC and in India. Also, I see that there are a lot many webinars are going on, and from my side, actually, I would like to discuss with you that as you guys are aware that the UAE corporate tax law was released on 9th of December. And then coincidentally, the tax rate is also flat tax rate, 9%. And then again, I mean, third 9 is like you have to submit your corporate tax return within 9 months from the end of your financial accounting year. So this is just a coincidence. You know, 9/9/9. In Dubai, Metro was launched on 9th. So I think UAE government actually, they like 9th of December. 9 number is very lucky number for them. And then one thing I would like to advise you, because if you look at the entire GCC, the 9% tax rate, which is there in UAE, is the lowest in the entire GCC. And guys, now only 6 days are left out as tax-free period. And from 1st of June, this will be the reality. And I think those companies, mainly I think Australian companies who are having their financial year starting from 1st of July, or maybe the companies whoever like is having the financial year starting from 1st of June, 1st of July till 1st of December, on their it will be applicable this year itself. Otherwise, those companies who are having their financial year from 1st Jan to 31st December or 1st April to 31st of March, for them it will be applicable from 1st of Jan 2024 and 1st of April 2024, next year only. So, and then you guys are aware that now corporate tax UAE Federal Tax Authority has already allowed to register for the UAE corporate tax. You can go and register. Registration is very simple actually. They have used the technology to the to the best possible manner, and you can register the SSEs in just 2 minutes, because they already linked the data of UAE corporate tax with the UAE VAT database, which is already there. So that is very, very straightforward. And then they have given a lot of reliefs. I mean, one of the relief which is available for the individual, like up to 1 million dirham turnover, they don't have to worry. They don't have to register. They don't have to submit any corporate tax return. And then if you look at a few small businesses, there is another small business relief, which is available for the companies, small companies or startup companies whose annual turnover is like up to 3 million dirhams per year. So for them also, I mean, this is a relief, but yes, for them, they have to register and they have to submit the corporate tax return, nil return, and then only they will be eligible to get this small business relief. And then one more important thing which I would like to highlight, GAR, General Anti-Avoidance Rule, which is generally introduced in any other country after a couple of years, I mean, after the corporate tax is implemented. But in this country, I mean, GAR is already implemented. I think last year itself, from 15th of December 2022, it is already in effect, and it's already implemented. So if you are changing your accounting year, or if you are changing the enterprise structure of your company, then you have to have proper commercial and solid solid reasoning in order to change either tax period or your accounting year, or maybe you are moving your company, you are opening up another company in order to avoid the tax. Then in that case, you need to have solid reasoning. You need to properly document it and keep it ready. Discuss with your tax advisor, and then only you do these changes. Otherwise, FTA, Federal Tax Authority, might take it very serious, and they can actually reverse all the changes whatever you have made, or they can roll back or recharacterize whatever changes you have made in your enterprise structure or the tax period or any other, if you are trying to avoid taxation. So these are the few cautionary or precautionary measures I suggested you. I think I've done from my side, Agrawalji, available at the time of Q&A. So if you have any question, we can take it up. Thank you.
Yeah. Thank you, Rankavat Bhai. Ari Bhai, as you have already always supportive to the institute, be in touch with everyone who reaches there and seeks your help. May I request now Abu Dhabi Leadership Chairman John Bhai to say a few words?
Thank you, Sanjay Agarwal ji. Actually, I'm really excited because the institute is taking so much efforts to support the overseas. Actually, the credit goes to the chairman, Sanjay Agarwal ji, and the vice chairman, Piyush Chajit ji, for they have got a great background material, and it's going to be used by many of our colleagues here. Actually, we circulated to many accountants for using it as a handbook. It's very detailed, very it gives really insights to that particular about corporate tax. And I really thank the efforts they put and the meeting they organize for the members. It's really amazing, and hats off to you, the efforts you're putting. Thank you for that. And without your support, this would not be possible. Creating a handbook from Abu Dhabi chapter or Dubai chapter is not possible because you don't have that in-depth knowledge. I'm here for more than 20 years, where I studied tax when I came here, there was no tax. And so it's a really free mind when you work, even you can do any entries, you can make invoices, you can cancel invoices. You do what you want, you change entries towards the end. And nobody cares about accounts. In the sense, if there is no responsibility towards the government. Now, I am not going to technical things because we have great speakers, SP Singh and Vishab Agrawal ji is there. So they will go into technical because they are much better. So actually, we are proud because the profession will get more weightage, more importance in this country, because we need chartered accountants who knows the corporate tax. Now the people start hiring like anything. Especially the consultant started doing the assessment studies, and the people started recruiting. So I really thank for opportunities. I really thank CA Pradeep Singh ji, is the regional director, for giving opportunity, and the committee for giving the opportunity. And so I will not take much of your time, and we are here. I need to leave because we have a technical seminar at Abu Dhabi chapter. I need to go for that. So let me conclude my words and saying there is a great opportunity. There will be great response for accountants, because accountant has to be there in a company where tax need to be handled. So there is a great opportunity. And if anything, just reach out, and we are here to support you. Chapter is there to support you. If you want to conduct more seminar, please approach the Direct Tax Committee, and they will organize, and we will be here to support them. Thank you very much. Thank you for this opportunity. Thank you, the speakers. All the best. Thank you very much.
Yeah, thank you, Don, for giving your valuable time. And do circulate this study material or background material for certificate to the authorities also. If you have connect over there, give them so that we can take their feedback, and also we can improvise this. Already we are making the revision for the last few amendments which have been there, and a lot of questions which have come. We have requested speakers to give us the feedback on this background material and revise, and we'll come back with the revised background material very soon. Thank you, John.
Thank you very much. Thank you very much. It's a pleasure.
Yeah, may I request SP Singh sir to take charge now and do the needful for everyone here.
Thank you. Thank you, Sanjay ji. Thank you, Sanjay ji. Respected dignitaries present for the presentation, a dear august group of attendees in this webcast, CA Rishabh Agrawal ji, the presenter for today's webcast, and the members of the Secretariat of the Committee on Direct Taxes. Good evening and welcome to this important webcast. The earlier speakers have set on fire desire to know about the recent developments in the area of UAE corporate tax law. You all must be eager to hear from Rishabh. I am honored to be requested to be the keynote speaker. I am obliged to CSC Sanjay Agrawal ji, the chairman of the Direct Taxes Committee, for giving me the opportunity. I earlier used to think that the job of the keynote speaker is very, very easy. But after watching a couple of matches in IPL of Chennai, I have started realizing that it is not so. And I have full sympathy to Ravindra Jadeja. Whenever 1 or 2 wickets are gone, I mean, after the initial, the opening batsman, people start looking towards the player area and always want Dhoni to come out. The poor guy, Jadeja, when he comes out, people keep on shouting Dhoni, Dhoni, Dhoni. And that's the demand of the people who have come to watch. Friends, I will not like to stand too much between you and the present seminars Dhoni. That's the Rishabh. And but I will do a little bit of talking and then hand over to Rishabh, who will enthrall you with his expertise on UAE taxation and the way he represents that. I'm a fan of it. So, as you have heard from the earlier speakers, UAE is modernizing. It is modernizing its economy. It is modernizing its taxation. It is modernizing its accounting system. Gone are the days when UAE used to be identified with oil revenue. Here is a country which is growing at a very high rate. Not only that, it is opening up for foreign investment, and it is encouraging its residents, the people in UAE, to invest abroad. The recently released data shows that the rate at which the GDP of UAE is growing is 9.3%, which is among the fastest in Middle East and North African region. The growth across its diverse sector is attributed to the robust economic framework, coupled with a collaborative approach from both the public sector as well as the private sector. It is solidifying its international position and retaining its competitive edge while also maintaining a stable macroeconomic environment. A lot of money is being put in the industry sector. It is trying to become a competitive center for industries. A lot of money is going into that. And it is going to facilitate access to finance, enhance ease of doing business, attract foreign direct investment, improve access to quality infrastructure and utilities, and supporting collaboration with local and international partners. To achieve its goal, UAE will be helped by its wide network of tax treaties. I understand there are 90 plus tax treaties. So it's a huge, network of tax treaties. Now, these developments, why I have mentioned these developments, because these are giving opportunities for India, the investors in India, not only who want to invest outside, but who want to encourage or who want to invite investment from UAE. We have the opportunity. We need to reach out to them. And we reach out to our friends in UAE, various chapters, to create an environment where the trade between the two countries increases still faster. Friends, you know that UAE is the second largest trading, India is the UAE's second largest trading partner, accounting for 9% of its total foreign trade and 14% of non-oil exports. Also, the UAE is India's third largest trade partner. India-UAE trade increased from $180 million, 18 million per year in 1970s to approximately 80 billion in financial year 21. So it's a gigantic increase. It is expected that the value of UAE's non-oil trade with India will increase from the current $60 billion to 100 billion over the next 5 years. So UAE is projected to surpass bilateral trade worth approximately 88 or 90 billion this year, and is going to become our the third largest trading partner after USA and China. UAE is the 7th largest investor in India, with cumulative foreign direct investment inflow of approximately 15 billion US dollar between April 2000 to September 2022. Now, in order to make its presence internationally, in order to attract foreign investment and to encourage investment outside, UAE has come out with a corporate tax law, which is the subject of discussion today. It wants to cement its position as a leading global hub for business and investment, wants to accelerate its development and transformation to achieve its strategic objective. And the law, when Rishabh will talk, and what Rishikesh ji mentioned, is that they're trying to come out with a law which is in line with the international understanding, or the one which is put up by OECD in respect of taxation, in respect of transfer pricing. This law, as mentioned by Rishikesh ji, has come into effect in the first half of October 2022 and is effective from 1st of June 2023. I need not have mentioned that the rate of 9% of corporate tax is very, very competitive. In fact, it is lower than 10 or 20% taxes, which is imposed in the in majority of the countries in that region. Now, that would give incentive for investment in UAE and vice versa. The corporate tax law is nicely drafted. It comprises of 20 chapters, and instead of sections in India, they are called articles, which cover inter alia the scope of corporate tax, its application, and rules pertaining to compliance and the administration of the corporate tax regime. The latest thing which has happened, and which is the topic of discussion today, is on the 12th of May 2023, the Ministry of Finance has released explanatory guide on UAE's corporate tax law. And what they have done, they have structurally made it mirror image of the corporate law, in the sense it also has 20 chapters and 70 articles which gel one-to-one with the corporate tax law. This would make easy reading of the guide. The guide is designed to provide a detailed explanation of each article and intended purpose of the provisions of corporate tax law and executive decisions based on its implementation. The explanatory guide must be read in conjunction with the corporate tax law, obviously, and the relevant decisions which are issued or the rulings which are issued by the government of UAE for the purpose of applying the provisions of the corporate tax law. I would highlight some of the significant facts of the UAE corporate tax law. Many of them have been highlighted already by Rishikesh ji. I will not touch upon them. UAE has adopted a mixture of residence and source-based principle of taxation. While Article 13 defines source rule, Article 14 defines permanent establishment. And when you go through the article on permanent establishment, you will realize that it is very much similar to the definition in Article 5 of the OECD module, OECD manual. The law defines person, and it's a very wide definition because it includes a natural person and juridical person, and the definition of juridical person is very, very broad. It also defines related party very elaborately and lays down detailed provisions regarding transfer pricing law, which consists of arm's length principle and the method for determining the arm's length price. The guide goes on to elaborate all aspects of the methodology and the documentation which is required for that. It's a very, very comprehensive one, which has been prepared, keeping the reader and the implementers in mind. It would benefit all stakeholders. Rishabh will take us through the important provisions and their explanation very elaborately, and he will be very focused, and he will agree with me that there cannot be a person better than Rishabh to talk about this thing. Rishabh, over to you.
Thank you, SP sir, for such wonderful words. And it's my privilege to be on screen with you and have you as my keynote speaker. And I would like to thank DTC, both the chairman and the vice chairman of Direct Tax Committee, to give me this opportunity. Hari sir, chairman Dubai chapter, to give a wonderful backdrop and the logic behind 9. We'll also go into the technical logic why 9% was introduced. And thank you, Abu Dhabi chapter chairman John sir, to be there for his welcome address in absentia, and also the regional director Pradeep Singh Baveja. He has been a great support for the members. Talking from my personal experience when I was in UAE, and he's the regional director for the Middle East and the Africa region for ICAI. So my regards to Pradeep sir in absentia. So before we go into the technicals, and I think SP sir and Hari sir have correctly touched upon the background amazingly. And for background, I don't think there are a lot of things that have been missed out. So, but whenever we see UAE as a jurisdiction, We confuse it with Dubai, and even in our day-to-day conversations, even in office or between professionals, we always say, oh, Dubai corporate tax was introduced in Dubai, or Dubai corporate tax. So it's a very confusing notion that it's Dubai. No, let me correct you, it's UAE, and geographically speaking, it's a combination or a group of 7 emirates, having like these 7 emirates. But when you see UAE commercially, or when you see UAE as a business jurisdiction, we see it only in 2 parts. First one being mainland, and second one being free zones. What are free zones? I would say the closest relative that the Indians would correlate the free zones would be the SEZ, or the special economic zones. Or in that case, let's say a gift city, that is an example of an IFSC. So that is there, and there are a lot of relaxations and everything available for entities operating in free zone. That is why a lot of businesses actually go and get established in the free zone as compared to the mainland. Similarly, there are certain benefits that are available in the corporate tax law as well for free zone entities, and we will take a deep dive into that when we go to the free zone articles, and see what are the actual advantages available and what are the conditions that need to be fulfilled by them. I would like to also tell that the lawmakers have done a commendable job. UAE has a lot of expatriates that come into UAE to do business, get settled, raise families, and the same thing can be seen in their law as well. It has international touches from Dutch law, UK law, Indian law, and you will see that there are a lot of provisions that you will resonate as Indian tax professionals when we talk about UAE. But nonetheless, there are a lot of unique features that we as Indian tax consultants do not resonate. But yes, UAE tax law has been made on international best practices and has summarized all the provisions that could possibly come in the shortest and the most concise way. If you look at the main law, it is just 60 pages. Now there are decisions from the cabinet, from the ministry, and from the federal tax authority being issued. But one thing common among all the decisions or all the legislation that they have come out with is that all the legislation is to the point, concise, and addresses a problem, solves that problem. And yes, there is ambiguity, there is open positions, but I think that is there in any new legislation that is introduced. And with time it gets solved, and also with stakeholders making representations, it gets solved. So this is a little about the tax environment on corporations or corporate tax right now in the UAE. Going ahead, this is something that we'll try and deal with in the rest of the session. For the technical part, the overview has been given by my fellow panelists over here, but we'll still touch upon certain important provisions. Going on, looking about who is a taxable person, the conditions for tax residency, because we all understand that the residential status of an individual, of a taxpayer, is one of the most important aspects to consider on what income or how much income or at what rate the income would be taxed. Right. And then we go on discussing about the free zone persons. What are the benefits available to them? What are the conditions they have to fulfill? Definitely, we'll touch upon the calculation of taxable income, because we all know the accounting income and the tax income are a little different and are on different principles. Further, we'll try and touch upon few provisions about exempt income, carry forward and set off of losses, which are more or less similar to what we have in India. Then the interesting part is towards the end, where we'll discuss almost all the recent decisions issued by the Cabinet, Ministry of Finance, and the Federal Tax Authority. I wasn't able to capture the last 3 decisions that were issued by the ministry, that's 114, 115, and 116 in the presentation, but we'll definitely discuss it wherever applicable. Further, there's another unique feature in the UAE corporate tax, that's about tax grouping. We'll go on, and then finally, the showstopper, UAE transfer pricing guidelines, because transfer pricing is something that people are looking it at as a good opportunity as well, and at the same time it's a pain, and it's a little difficult to comply in a region where the data or the corporate data is not freely available like we have in India, at least for the listed entities, and then with the MCA for all the companies in India that are doing regular filing. So the opaqueness of the region makes it a little more difficult to do or to apply the international principles regarding transfer pricing. So everyone knows now that there's a 9% rate, all thanks to Harisa's interesting story and the logic behind 9%. As you can see, and SP sir has correctly mentioned that 9%, it's still the lowest in GCC. I would say not just in GCC region, but globally. I think Hungary has a federal tax rate of 9% and no other country. It's either it's 9 or 0. In GCC also, we see Bahrain, which is still at a 0% tax rate. But that would have been true only till yesterday. So yesterday, the Minister of Finance of Bahrain, in one of his interviews, he quoted that we are in process of drafting a corporate tax law that is again in line with the international best practices, and we are also making provisions to implement Pillar 2, that is the global minimum tax of 15%. And I would say the Pillar 2 rules or the introduction of Pillar 2 was one of the driving forces behind UAE to introduce the corporate tax rate. And the logic of 9% is somewhat related to the subject to tax rules that is there under Pillar 2. I would not go too much in detail about that, but I would say, yes, there is a logic of introducing the tax at 9 and not at 10 or 8 for that matter of fact. This is exactly where we are standing. Last year, January, a bomb was released that, that UAE is introducing corporate tax and will no longer be a tax haven or a zero tax jurisdiction. First time in the history of UAE, as far as I am concerned, and I know that they released a public consultation document to take opinions from the stakeholders. Otherwise, never a public consultation document was issued before introducing a law. A lot of representations and a lot of clarifications were made, and they were given suggestions, or the ministry was given suggestions with the public consultation document. And finally, on 9th December, they published the final law. But mind it, there were provisions that are different both in the public consultation document and in the final law. We can just take little guidance from the public consultation document, but we know that law is law and it is supreme. And Hari sir mentioned in his address that in just 6 days, UAE will not be a tax-free jurisdiction. That is correct. But the article has been drafted very creatively, and it's a very good job by the lawmaker, because the lawmaker has written that the law will be applicable for any financial year beginning after 1st June. You would think that, how can people have different financial years? But yes, in UAE, you had the freedom of choosing financial years. There were like a lot of options available. A lot of people used to do it from the date when they're incorporated. Some used to follow like India from April to March. A lot of people do it as calendar year, that's January to December. And as rightly pointed out, a lot of Australian, New Zealand companies follow the financial year from July to June. So these companies who have financial years beginning after 1st June will be the first hit by the corporate tax. And they were the first ones who were invited to get registrations and fall in line with the new provisions. But the major chunk of businesses that operate in UAE, either in the free zone or in the mainland, have the calendar year as their tax year as well. So most of the entities would be coming into action only after 1st January 2024, and 2024 being their first tax year. About compliance, yes, you have to make your annual compliance after 9 months from the end of the financial year. So if if your financial year is January 24 to December 24, so your first tax return would go by 30th September 2025. And I mean, when you look at compliances in India, there are enormous amount of compliances to be done, advanced tax, TDS, TCS. But for UAE, there's only one compliance that has to be done. That is the annual return that needs to be filed from corporate tax perspective. there is one form, disclosure form, that needs to be filed if you are having related party transactions or you fall in the ambit of transfer pricing. Yeah. So when we hear the word corporate tax, we would think, that it is applied only on companies or corporations, but that's not true. Corporate tax is actually applicable on all the business or business activities or any sort of entity or any type of entity doing business or business activity in the UAE. So if you are an individual doing a business activity, having a business license, so you are under the ambit of corporate tax law, but obviously there are certain relief that are available to small businesses. So technically, all businesses, all UAE businesses fall under this law, except certain specific categories, which certain businesses related to natural resources, because they are already subject to local level or emirate level taxation, which are pretty high. And then we have certain public benefit entities like pension funds or qualified public benefit entities like charitable trusts, which are doing some social activity and will be considered as exempt. But however, they still have to register, fulfill the conditions, claim the exemption every year. And that's how it actually works in India as well, if you talk about charitable trusts. So when we say a 9% tax was introduced, so it's not exactly a flat 9%. You could see on the bottom of the screen that a basic threshold of 375,000 dirhams has been given. So we'll not say that income up to 375,000 dirhams is exempt, but it is only taxable at 0%. And that has been given by a cabinet decision. So cabinet decisions, ministerial decisions, and the decisions by the FTA are the closest relative to the income tax rules that we have in India. So the act says that beyond a minimum threshold, you will be taxed at 9%. That threshold has been defined at 375,000 dirhams. So in a situation where you have total income, total taxable income of 400,000. So for first 375,000 dirhams, 0%. So the next 25, 9%. So I mean, exempt, saying the income is exempt would be terming it wrong. It is taxable, but it's taxable at the rate of 0%. So that, the cabinet, whenever they want to lower this threshold, they'll do it in a couple of years, wherein as and when the jurisdiction gets matured as a tax jurisdiction. Similarly, when we see withholding tax or tax deducted at source, right now, the withholding tax provisions are applicable for both domestic and cross-border payments. But again, the catch is that you have to deduct tax at the rate of 0%, again issued by certain decisions and can be changed whenever they want. So they have kept this flexibility. And again, this is the beauty of lawmakers, so that every time they do not have to go by a very long procedure of amending the royal decree. Moving ahead, when we see a tax law, we usually see that who comes under this ambit, right? In India, we see Section 5 and Section 6, wherein Section 6 determines the residence, and then Section 5 tells you the scope of income that will be taxable in India. But over here, there is a mix. So for a natural person, if you are engaged in business or business activity in UAE, then you are a resident first, and then you are taxable on worldwide income. Don't worry, detailed rules on residence were introduced later on by a decision, but there is some anomaly still present over there. So if you are not having any business activity in the UAE as an individual or a natural person, you're not liable to tax. But for juridical person, there are again two internationally well accepted principles or theories. First one being an incorporation theory. So wherever you are incorporated, so if you are incorporated as per the laws of UAE in UAE, then you are a resident of UAE first, and then you're taxable on your worldwide income, right? But what if you're not incorporated in UAE? So UAE has another internationally accepted theory, that is the place of effective management, or the real seat theory. It's technically called that way. So if you are effectively managed from the UAE, there is a very small definition. They are not very elaborate rules as of now for POEM or a place of effective management in the UAE. But yes, we can take certain guidance from the OECD commentaries. We can take certain guidance from other international laws that what exactly brings effective management to a jurisdiction, like decision making or top level decision making, maybe not routine and administrative functions. So if you are effectively managed from the UAE, right? So you will be a tax resident of UAE and thus taxed on your worldwide income. If not, then only taxable on your source income, source income sourced from the UAE. But again, there is a catch here. There is a very, I would say, unique article, that is Article 66 in the UAE corporate tax law, that says that if any international agreement has contradicting provisions, then it will supersede or overrule the domestic law. So international agreements include the double tax agreement that have been entered by the UAE. In India, we have that the double tax agreement will override the domestic law to the extent it is more beneficial for the taxpayer. But that is not the case in UAE. Irrespective of a beneficial treatment or a deterrent treatment, if there is a conflict between an international agreement and the domestic tax law, the international agreement will supersede the domestic tax law. So over here, if we go and look at Article 4 of the India-UAE Treaty, so the residence rule for companies is written as it is wholly managed or controlled from the UAE. So the word wholly pushes us towards near 100% management or control from UAE, whereas the domestic tax law talks about effectively managed and controlled, and that we have seen host of jurisprudence in India on this differentiation of wholly and effectively, right? So effectively is majority, but wholly is near 100%, just to sum up that way. And this is just one example on how this Article 66 will function, where there is a conflict between a double tax avoidance agreement, a DTA, and the domestic tax law. And this is how there is an interplay, and it is at a more than one situation. This is one example that we have seen, but it is at more than one place when we look at the India UAE DTA, and the provisions or the articles in the India UAE DTA are a little consistent with certain more DTAs which UAE has entered. So you will see a host of examples of what I am talking about. And even during the session, we'll try and point out a couple of more of them, as we have done right now in the case of the residential status of a juridical person. This was the detailed instruction or the decision issued for residents. Technically, these rules were issued to obtain a tax residence certificate, that is a TRC, which helps you establish your residential status in a jurisdiction in order to obtain an advantage or a beneficial treatment in a double tax agreement. So it's for juridical person, it's the same, either incorporation or effectively managed. If yes, then you can go and apply for a TRC in UAE, and you can prove and take the benefits of the treaties that UAE has entered into. And for natural persons, if you go ahead, there are 3 rules. First of it being usual or principal place of residence along with your center of financial and personal interest. So basically, you have a house and your job and your family in UAE. I'm trying to put it in very simple terms, but it is much more intricate when we see principal place of residence, whether it should be owned, rented, could be a hotel, or like could be just an apartment you rent for half a year, or then center of financial and personal interest. It's very subjective, that probably you might have employment in UAE, but then you are doing business in some other jurisdiction. So where exactly is your financial interest lying? You have equal interest in both of the areas, both of the jurisdictions. So it is a little more of a subjective rule. But then second rule is the standard 183-day rule. So if you are present in UAE for 183 days in a consecutive 12-month period. So here again, I like to point out an overlap or a contradiction between the domestic law and the India UAE DTA, wherein it says in the domestic law, you can see on the middle box in the screen, it's 183 days or more in a consecutive 12-month period. But the DTA talks about 183 days in a calendar year. So calendar year is again January to December. So you could stay 3 months in 2023 and 3 months in 2024 But as per domestic law, you will become a resident because it's a consecutive 12-month period. If it begins, let's say, from July 23 to June 24. But then, as per the DTA, you will be saved and you will not become a resident of UAE. When you look at India UAE corridor, you would say, oh, it's beneficial for us to become a resident. We'll be taxed at 9% and whatsoever. But then I told you there are similar provisions in other jurisdictions as well, which are a little more beneficial sometimes in certain places. The last one is for UAE citizens and UAE residents or GCC residents who have a permanent place of residence in UAE along with their business or job in UAE. So for rule for them is again 90 days and not 183 days. So the whole catch over here is the same logic that we have under Section 5 and Section 6 of the Indian Income Tax Act, that once you become a resident, your global or worldwide income will be taxable in UAE. So, but minded, these rules which we are discussing right now are only for the purpose of obtaining a TRC or a tax resident certificate. And it's a simple process. You can directly go and apply online on the portal of the Federal Tax Authority for a TRC to prove your residence and then obtain benefits of the DTA. But there is one thing which has not been mentioned. It's only in the instruction manual of the TRC that a new company cannot obtain a TRC. So if anyone is applying TRC for a company that has been that is not at least 1 year old, then you will not get a TRC. So you cannot incorporate a company today and get a TRC tomorrow. You can incorporate a company today. You can apply only for the TRC after 1 year. And similarly for a natural person, you can apply only for the TRC if you're a resident for more than 183 days. So these things have been mentioned in the instruction manual and not anywhere else. But I think that is the reason that a lot of applications for TRC get rejected, because we do not see these rules while filing the application. There are little provisions about different types apart from companies. So we have partnership firms, trust and investment funds. A common logic between them is that they could either be transparent or opaque. When I say transparent, it's that they are not taxable as a separate legal entity. For partnership firm, the partners are taxed. For trust and family foundations, the founder, settler, and the beneficiaries are taxed. And for investment funds, the investors are taxed. But they have an option to apply as a separate legal entity. And once they do that, they will be taxed as a separate legal entity, as an opaque one, and they'll have to, all the rules of this or all the provisions of this corporate tax law will be applicable to them as a separate legal entity, as a juridical person. Sorry, going to the one of the most interesting areas, as I told you that we see commercially UAE into two areas, one being the mainland, another one being the free zone. So when we look at the free zone, so first question comes in that what are the benefits available from corporate tax standpoint of view. The main benefit is that you are taxed at 0% rate, but there is a catch again, that only at your qualifying income. What is qualifying income? That is still in thin air. No decision has been released. We're still waiting on that. So every free zone entity or any entity in the free zone is a free zone person. But to obtain the corporate tax benefits, you need to be a qualifying free zone person. So how do you become a qualifying free zone person? You have to fulfill these 4 conditions that you see on the screen. First one being you have to maintain an adequate substance. Second one being do not voluntarily elect for the normal tax regime, that is the 9% tax regime that we were discussing with the minimum threshold and all of it. Third, you should have some qualifying income. And fourth, you should comply with TP regulations, transfer pricing regulations. That is that you should have transaction at arm's length and you need to maintain a TP documentation. There is a decision that has been issued on TP documentation. We'll discuss that when we'll see the ministerial and the cabinet decisions. But then there are two, let's say, lacunas over here, wherein we say, what do you mean by adequate substance? So that has not been defined yet, neither in the law, neither in the nor in the explanatory guide. So we are like desperately waiting for the decision to come to define adequate substance first. And second, what is qualifying income? Because these two are the hurdles that are there for businesses to decide whether they should open in a free zone now or should stay in the mainland or should shift to the mainland and leave the free zone or whatever sort of tax planning that is available. They can do, but these two hurdles need to be cleared out. Only then we'll be able to do it. There is a little guidance about substance from allied laws, one of it being ESR or economic substance regulations, wherein it talks about that substance, the factors to be seen for substances, employees, offices, assets, your revenue and all of it. So there's again detailed conditions, but then again, it just has persuasive value and not conclusive value. Reason being, you will first look in the corporate tax law and related decisions and explanation, then go to another law, and it will be very difficult to import a definition from another law into the corporate tax law. The second hurdle I talked about is qualifying income. No clarity on that, but it was defined in the public consultation document that was issued back before the final law was published. So we'll see the examples of qualifying income that were given. But again, this is not the final set, but at least it shows the thought process or the chain of thoughts of the lawmakers altogether, because you will feel that it makes some sense that these will be qualifying incomes. So I think, yes, now on your screen, you could see that what will be a qualifying income. So first is all of your international income, both active and passive. Second is your income from another free zone person. So any other entity in any of the free zones across UAE, it will be considered as qualifying free zone income. So there are about, I think, 45 free zones across UAE. So if you have income from any other free zone entity across UAE, should be taxed at 0%, not exempt. Mind it, taxed at 0%. Then it also says that if you have certain incomes of passive nature like interest, royalty, dividends from a mainland entity, we will tax you at 0% for that. If you have active income, so if you're selling goods, let's say to a mainland entity, probably you will be taxed at 9%. So there is a very not so complicated sentence, but a very meaningful sentence that has been written, and that is the way the exemption has been given. It says qualifying income that we have seen, what it could be, what it is not exactly right now because there is no clarity. So qualifying income of a qualified free zone person will be taxed at 0%. Now you will have a question that where there is qualifying income, there will also be a non-qualifying income. So what happens to that? That has been cleared and was pretty clear earlier as well, that the non-qualifying income will be taxed at the rate of 9%, and the basic threshold of 375,000 dirhams will not be available on non-qualifying income. So let's take an example, because in the previous slide, one of the conditions was that you do not opt voluntarily for the 9% tax regime. You would think that where a free zone person can get a 0% tax, why would he go and opt or why would that company go and opt for a voluntary regime of 9%? Let's take an example wherein your total income is 600,000. So 400,000 is qualifying and 200,000 is non-qualifying. So total is 600,000. So on the 400,000 of qualifying income, you're taxed at 0%. Very happy, right? But on the next 200,000, that is non-qualifying, you are taxed at 9%. So this is an ideal scenario where you will pay 9% tax and be like, okay, fine, I get the benefit. What if the situations are reversed? That 400,000 is non-qualifying and 200,000 is only qualifying, right? So on 200,000, you will be taxed at 0%. But on 400,000, you will be taxed at 9%. Now, if you go into the voluntary 9% or the normal regime, so 600,000 total income, 375, 0. Only taxed at 225, that is the remaining 225,000 at 9%, wherein in the free zone regime, you are being taxed at 400,000. So this is a cost benefit analysis that still needs to be done. And again, it is only based, or let's say the weight is only of the definition of this qualifying income, because it will help the even the free zone people, free zone entities to decide whether they have to go into the voluntarily 9% regime or not. So this like pretty much sums up what the benefits are there for a free zone person in the corporate tax law. Moving ahead, we have this. You usually, when you see the stock market, you see the green arrows. Green arrows are pointed upwards, and the red ones are pointed down. And over here, I have done a little reverse because over here we are talking about the taxable income or the tax base. So, as a taxpayer, you always want your tax base to go down and not up. That is why up again is the sign of danger, and that hence red, and the reduction from the tax base is still in green. So the starting point of calculating your taxable income is your accounting profits. And that is pretty much the same everywhere. Now, a decision was issued recently that the accounts have to be made as per IFRS, or for certain SMEs, for entities with less than with revenue of less than 50 million, you can use IFRS for SMEs. So basically, IFRS for SMEs are a little simplified version of IFRS. Very small differences, and in the treatment, little less disclosures, but pretty much on the same lines. This is what I have been told by my friends who do IFRS work. So so the accounts will be made as per IFRS. That will be a starting point to calculate. There are certain things, as we all know, there are differences between accounting profits and taxable profits. So there are certain things that need to be excluded if they are already credited, and certain things or certain expenses that have already been debited to the accounting profit that needs to be added back, as we do in India as well. So like this is just an indicative list of what we have. For exclusions, they are domestic and foreign dividends. Again, conditions apply. We'll discuss in what scenario or what conditions need to be fulfilled for dividends to be exempt. Foreign exchange gains, impairment gains, capital gains as well. Yes, you heard it right. And to add back, if you have debited any donations, grants, unrealized profits, losses, and donation grants, if not given to a qualifying entity or an entity that's exempt for charitable purpose, then fines and penalties not deductible. Bribes, illicit payments, again illegal payments are never deductible never a deductible tax expense. Again, foreign taxes paid, dividend profit distributions, if any, if you have debited out to your profit and loss account, they need to be added back. So it's more or less in the same lines, and these were just an indicative list. There definitely will be more items when you actually look at your profit and loss, that what expenses and what incomes you have been including over there as per your accounting standards. That's IFRS now. So I mean, it's another exercise to go back and calculate your taxable income for the compliance part. But good part, it's still in 2025, so we are happy that we still have time to do that. Going on, I told you that there are a few exempt incomes, but again, conditions applied. So dividend from local companies, foreign companies, capital gains from local and foreign companies. How are they exempt and what are the conditions? That can be seen here now. So if it's a domestic dividend, it's clearly exempt, and it has been mentioned specifically in the exempted income articles, or income that are outside should not be included. For foreign dividends, there is a concept of participation exemption. So it basically says that if you have certain shareholding for a certain period of time, then we will exempt you these incomes. And it was just brought in to remove double taxation, because at last the dividends are distributed from your tax paid profits. So you could see the conditions, or the primary conditions for participation exemption, in the green box, which says that the holding company should hold at least 5% of the company distributing dividends. Hold that 5% for at least 12 months. It's an anti-abuse rule that you will not, today you will hold 5%, increase your holding beyond 5%, take the dividend and sell it back again. Right? You need to hold it for 12 months. And then the distributing entity shall be subject to tax at minimum 9%. That is, it should be tax neutral. in terms that your distributing entity should have paid tax at 9%. So if you are getting dividends from another tax haven to UAE, then it will be difficult for you to prove participation exemption because the effective tax rate would be less than or the subject to the marginal rate of tax would be less than 9%. Looking at capital gains are only exempt in case of participation exemption that we have seen, be it local or be it of foreign subsidiaries. And going ahead on detailed conditions of participation exemption, I already told you that why it was brought in. It's not a very unique concept, but a good one, that it helps to remove double taxation. We suffer that in India as well, that once the dividends are being distributed, now tax is being deducted under Section 194. We also pay tax under other sources on it at slab rate also. So this difficulty, or let's say this problem, has been mitigated by this regime that we call participation exemption. There is one, let's say an anti-abuse rule that has been introduced that says that if there is an intermediary entity and that intermediary entity holds different more entities which would not qualify for participation exemption, and they are more than 50%. So the entity or the first relationship would also not qualify. So it's not that, let's see that with the help of an example here, that H and S qualify all the conditions for participation exemption, that at least 5% was held for 18 months, that more than 12 months, and S is taxable at 25%, so more than 9%. So all these conditions are fulfilled for H to obtain participation exemption for the incomes that are being distributed. Let's say dividend being distributed by S to H. But then when you look at the assets or when you look at the holdings of S company, you see three of them. So we can assume that 1/3 each, so equated. So the first entity that's on the left is taxed at 4%. Is just we are holding just 4% in it. Taxed at 20%, held for 18 months, right? But 4% holding, that's less than 5, so it doesn't qualify for participation exemption. Then we see second entity, we are holding more than 5%, holding it for more than 12 months, but then taxed at 0%. So this also doesn't qualify. So we could say that the 2/3 of the asset of S company do not qualify for participation exemption in a scenario wherein S company was not as the intermediary entity. So what we would try to do here is that we will take all the incomes from these operating companies and S, and then finally remit it out to the to the UAE and claim participation exemption. Wherein if we remove S, the income coming from the first two entities will not be exempt under the participation exemption regime. Only the income coming from the third one will be exempt. So they've put this backstop rule in order to prevent this type of tax leakage as well, wherein one entity is introduced as an intermediary entity just to circumvent the previous three conditions that we saw. This participation exemption clause is, I would say, of great help. Again, a beauty of the person who has drafted the tax law or the lawmakers, that they have included this provision in order to mitigate a problem that might arise in future in terms of distribution of tax-paid profits, and like a commendable job done by them. Moving ahead, we have certain decisions. I told you that I couldn't factor in the last three decisions, but we are taking them up during our deliberation. This is a timeline of all the cabinet and the ministerial decisions, along with the decisions issued by the FTA. And we can quickly go through all of them, what were their key takeaways, and how they impact the implication, or how they impact the application of corporate tax law or the provisions stated thereunder. First one was the cabinet decision that actually gave out this threshold of 375,000 dirhams. So I told you it can be amended anytime the cabinet wants, and they can lower this threshold, let's say to 100,000 or to zero in no time. and they do not have to go and amend the law. Second one is little irrelevant for private businesses because it's for government entities. Technically, government entities are exempt, but then if they are doing a commercial business, they fall under this ambit, and they have just given it for the ease of compliance that all the government, let's say for federal government, they have taken 20 licenses to do 20 different commercial activities, so they all can club into one, and they'll file one tax return, and they'll have just everything consolidated for corporate tax perspective, and similarly for the emirate level or the local governments as well. The third one here is for the qualifying public benefit entities. So a list was annexed to this decision which told that these entities are exempt from corporate tax. These entities were primarily for benefit of the public, engage in social responsibility, public welfare, and what we understand as charitable activities when we talk in the Indian context. So there was a list of entities that was given. It was also told that if you want to apply for it and you fulfill the conditions, you should apply for it. And we'll amend the list as and when required. And further, there's one catch which says that you still need to register for corporate tax. And we'll see that every year you fulfill those conditions of charitable or public benefit while giving you the exemption. Fourth decision of the Ministry of Finance relates to an exemption from corporate tax, even corporate tax registration we are talking over here. So government entities, government controlled entities, businesses that are into extractive and non-extractive natural resources, and a non-resident who has only source state income, basically who does not has a permanent establishment in the UAE, is exempt from registration for corporate tax. It was a major relief for people deriving state source income because the definition of state source income under Article 13 was pretty wide, and it included like any income derived from a resident of UAE, including sale of goods and provision of services. So it would have been really tough for people who export material to UAE to register every time they export to some country. So this is a very nice or let's say a very good relief from that point of view. Going ahead, Hari sir mentioned about a small business relief. It targets, again, as the name suggests, the small businesses. It says that if your revenue does not exceed 3 million dirhams, we'll consider as your taxable income nil. Right? It does not apply again to people who are taking benefits of free zone or who are qualified free zone persons or who are a constituent entity of an MNE group or a multinational group that fall into the scope of Pillar 2, as the guidelines say about that. So now you will see that two thresholds have been introduced. First threshold is on revenue for small businesses, that's 3 million. And then you have one threshold of 375,000 dirhams on the taxable income. So you need to cross both of them to effectively pay tax. So in a situation where you have, let's say, 2 million of revenue, and out of it, like 50% is profit, let's say it's utopia, but out of 2 million revenue, you have 1 million of profits. So you cross the basic threshold of 375, but then you can claim the small business relief. So small business relief needs to be applied, and this relief needs to be obtained to consider your taxable income to be nil. In a flip side scenario, what could happen is that your revenue exceeds 3 million. Let's say your revenue was 4 million. You are not eligible for small business relief. But then your profits are less than 375,000. So whatever income you have or whatever taxable income you have will still be taxed at 0%. So this is the catch on where you have to cross both the thresholds to be effectively taxed. Right? Sixth decision was about audit of the financial statements. The audit market was primarily controlled by the banks in the UAE, and not a lot of statutory audit was happening. Now, the ministry has released that every qualifying free zone person, basically any free zone entity which is obtaining the benefits of corporate tax law or zero or the preferential regime of 0%, will need to get its financials audited. right? So initially, or I would say before this decision came out, already the major free zones or the well-reputed free zones like DMCC, DIFC, they were already requesting for audited financials. So it is not, let's say, a new or a compliance burden on free zone persons. It's just that the government or the ministry has made it clear that if you have to take any advantage of being in a free zone, we need it audited by a independent auditor, right? And similarly, again, a revenue threshold has been introduced. So if your revenue, you are in mainland, or if you're not a qualifying free zone person and your revenue crosses 50 million dirhams, so you should get your financial statements audited. 50 million dirhams again is the threshold for micro and small businesses, so that they do not have additional compliance burden and cost of compliance for getting their financials audited. Talking about permanent establishments, this decision was majorly for, let's say, for non-resident entities who usually send their employees or one of the individuals to UAE for some work. And it just clarifies that if that person gets stuck in UAE because of unforeseen circumstances like a natural calamity, a war, terrorist attack, or his health or his relative's health, then we will not make a permanent establishment just because of some unforeseen circumstances. So it was, let's say, a relief provision from the point of the creating a permanent establishment in UAE. So it was just, not a, let's say, like a big chunk of taxpayers being covered with this, but then yes, whoever is being covered will not be given unnecessary pain and will knows that they have the relief mechanism for that. Minded, this could still be misused somehow, but then God knows, and this the enforcement of the law will tell that how much the law or with what intensity the law is being enforced, and what would be the scope of being creative. Because I always quote that we tax professionals or chartered accountants are very creative mammals or very creative people that we find ways to circumvent law, or we even not even law, but we find ways to get our work done, basically. Right. So the eighth decision is about changing tax periods. I mean, again, applicable to a very small number of people. We did deal with a client wherein its first tax period was beginning from 1st June 2023, and then he's confused on how to regularize it to the calendar year. So we told him that you need to apply for it, and you make your first tax period only for 7 months. That's from June to December. Take a corporate tax registration, do the compliance and everything later on. And then you can regularize it from 1st of January 2024 to make it your second complete 12-month tax period. So there are unique situations in UAE, as it was told even in the welcome address, that it was not regulated at all. People did not believe in keeping good accounts. So I would say tax law is consequential. First primary thing would be to have proper books of accounts and proper financial statements in order to comply with tax law. So with this advent of introduction of tax law or corporate tax law, not the business, not just for tax professional increase, but the business for accounting and people who are good at IFRS also increases. Reason being, that is the base data that you will feed to tax consultants. If the base data that comes to us for advisory or for compliance is not right, or it's let's say not arranged properly, it will be very difficult for us to give a valuable advice or a correct advice for that matter of fact. So tax is just a consequences of you maintaining proper books of accounts, or let's say proper tax compliance is just a consequences of making good books of accounts and financial statements. The ninth one relates to tax deregistration. Simple one. Just it was more than a decision. It was a clarification that within 3 months of cessation of business, you need to file to deregister your business or to deregister your TRN. So TRN is a tax registration number. That's the alternative to PAN, what we have as permanent account number in India. It's your unique identification number for corporate tax purposes. and I think it is different from the VAT TRN as well. So you will probably have two TRNs if you comply with VAT and as well as corporate tax. Again, certain exemptions were given for these public benefit entities, pension funds, social security funds. They were given a timeline to register. So the public benefit entities that were mentioned in the earlier decision that was brought out should register by 1st October 2023 and obtain a tax registration number. Similar requirement has been made for qualifying investment funds, pension funds, and social security funds that they should register up to 1st June 2024. And once they obtain the TRN, they should apply for being exempt within 60 days. So these all rules could actually have come later on also during the implementation, but then we see the proactiveness and the thought process of the lawmakers that they are bringing in such complex rules. And I did applaud them for bringing these rules in a very concise manner. I don't think right now the law plus all these decisions that we are seeing exceed the length of, I think, 150 or 170 pages, all like everything. So if you read that, you know almost everything about, at least about corporate tax law in the UAE. These two the decisions, first one is that till when the exempt person status would continue. It was just again a clarification to remove the ambiguity that it will continue if you are, even if you are in liquidation, provided that you have fulfilled certain conditions. This decision 12 or the cabinet decision 49 was a game changer because there was certain ambiguity on the part of what types of income will be taxable for a natural person, because the definition says if you do a business or business activity in UAE, a worldwide income is taxable. So they said first, the ministry said that, okay, we'll release the types of activity in terms of licenses that, oh, if you do these activities while having a license for doing these activities, you should pay tax. But now they have given a relief and you see another number popping up that is in millions. Now you have seen 3,375,000. Now we see this threshold of 1 million, wherein it says if your revenue doesn't cross 1 million of 1 million dirhams, you are not liable even to register for corporate tax. So you can do business and not even register. So like we saw for public benefit entities, you to obtain an exemption, you would need to register. But over here, if you exceed 1 million, you are not even liable to register. Also, they have given the method, or let's say guidance on calculating your turnover, which says it will not include your employment income. It will not include your personal investments, like your interest that you are deriving, dividends that you are deriving, capital gains, provided you do not need license to do that activity. Similarly, it said your real estate income will not consider for this turnover. That is your rent, the rent that you are deriving from the real estate activity, leasing, sale, all of this, or all types of income that you're deriving from your real estate activity, provided that to do that activity, you didn't need the license at first place. So in a scenario wherein you required a license, right, then you will have to add it to calculate that 1 million of turnover. So it was again a very great relief for individual taxpayers that up to 1 million, no registration also required of turnover. Up to 3 million of turnover, registration required, but taxable income nil. Beyond 3 million of turnover and profits or taxable income greater than 375, that is the time wherein you will pay the tax for the first time. So I would say that till 3 million of turnover, you can claim small business relief. Till 1 million of turnover, you are not even liable to register. What else? I don't know. Could be more beneficial for any taxpayer in any jurisdiction for that matter, that you are not even liable to register to claim that benefit of 1 million, or that you will not pay tax, or your taxable income is zero or nil for that for corporate tax purposes. Here comes the demon which shattered a lot of dreams for a lot of TP professionals in UAE, that the documentation threshold that was kept for transfer pricing was increased or was very high. That included the local file and master file to be maintained only if your revenue exceeds 200 million. That turns about to be 450 crores in rupees. And only if you are in, again, a constituent entity of an M&E group that is under the scope of Pillar 2. But there is a, let's say, a caveat over here or a catch again over here that maybe it's right that you are not bound to maintain a transfer pricing documentation, but it never says that you do not have to transact at arm's length. Irrespective of the 200 million threshold, all the related party and connected person transactions need to be at arm's length. And I would like to point it out that it requires benchmarking to be done to arrive at an arm's length price. So do not think that, oh, I am below the threshold of maintaining a TP documentation. Yes, you are right. You are below the threshold to maintain a TP documentation, but there is no threshold to transact at arm's length. You have to transact at arm's length irrespective of your turnover. It's just that you need to have transactions with your related party in order to fall in the ambit of transfer pricing provisions that are a part of the UAE TP regulations. So a lot of companies, might be looking to avoid benchmarking, but then it will create a problem because when you look at Article 55 that relates to documentation, TP documentation, first it says, yes, you require TP documentation if you cross a threshold. But it also says that you will be bound to produce documents to prove you transacted at arm's length later on. Maybe not in the form that they give of a local file or a master file, but you need to prove, if asked by the FTA, that you transacted at arm's length. We'll stress more on this issue because it's very controversial, and I have been receiving multiple queries on this point that my client is below the threshold. What should we do? Should we do benchmarking or should we not? So we'll deal it quickly through when we reach to the point of transfer pricing regulations in the UAE. Last one, as rightly pointed out even in the welcome address, that the registrations are open, but it's only open right now for LLCs, public joint stock companies, and private companies. It's not really open right now for natural persons. So for people who are eligible to obtain a tax registration number should apply for registration. The registration process is very simple. You do not need anyone's help. Most of the data is pre-populated or auto-populated from your VAT data if you have a VAT TRN. Otherwise, you have to manually fill it. But even then, if you have to manually fill it, I won't say it would take more than 25 or 30 minutes to fill the complete application. And the turnaround time is pretty quick. So go ahead and start applying for your tax registration numbers. And let's say, be the part of the era that introduced corporate tax in UAE. So coming back to the provisions of corporate tax law, this was it from, let's say, it was a very quick summary of all the decisions that were issued till last week. I would say it's safe side. And then we jump back again to the substantive provisions of the corporate tax law. The one you see on screen relates to carry forward of losses and set off. So something similar what we have in India, but the time period is indefinite. So it says you can carry forward your losses for unlimited years. So at last, if you are doing some genuine business, you will utilize your losses to set off your profits. But again, only condition over here is that 50% of the shareholders should be same in both first, where the year in which the loss was incurred, and the year in which loss is being set off. So if the loss was incurred in 2024, that is the first tax period. So 50% of the shareholders. So let's say you are setting off some losses in 2027. So they should be the shareholding should be same, at least 50%. But again, there is a saving clause which says no problem. If you have changed 50%, fine, we will accept, provided that the new shareholders are carrying on the same, not exactly same or similar business. So if you are, let's say, in shoe manufacturing industry, and if Earlier, you are doing, let's say, cloth shoes, and now you are doing leather shoes, and 50% of more shareholders have changed. Still, you will be able to set off your losses, carry forward and set off your losses eventually. For set off, very good provision is there that you cannot set off complete losses. You can set off losses up to a maximum of 75% of taxable income. But if you see it with numbers, it will look that, okay, you are setting off your complete losses. The reason being, you always have that minimum threshold of 375. That is why this is one deterrent effect of calling it as taxable income, because it is taxable, but taxable at 0%. Beyond anything beyond 375 is taxable at 9%, yet taxable income. So 75% of taxable income usually will help you out to set off any profits that you have, any losses that you have. So once these provisions are into play, you will see how these numbers are functioning. Until unless the ministry or the FTA bring on certain rules, more rules for set off of losses. So certain conditions that set off before losses before your tax period or effective date of corporate tax, or before you have registered will not, before you become a taxpayer will not be considered. And that's it. I would say that is a very genuine ask, where for a jurisdiction that is introducing a new corporate tax law, and with such commendable provisions and allowing you to set off for unlimited period of time. Going on to this, what you see on screen resembles with section 94B. That's an interest deduction limitation rule that we have in India. Something very similar, but little differences. In India, what we see is the interest being paid to associate enterprise or related parties. Here, this article talks about the net interest expenditure. So net interest expenditure has been defined as excess of interest expenditure over interest income. So your interest expenditure can be set off with your interest income also, but that is not the case in India. In India, it is interest being paid to associate enterprises. Right. Again, the maximum set off or maximum deduction that is allowed for interest expenditure is 30% of earnings before interest, tax, depreciation, and amortization. So it is in line with BEPS Action Plan 4. That is why it looks very similar, because again, it is in line with international best practices and principles. And this also clearly shows the intent of the UAE government to keep, keep itself compliant with international rules and have anti-abuse rules, backstop rules, and everything that can lead to tax leakage. Right. Over here, you can carry forward the excess interest expenditure for a period of 10 years or 10 tax period, you can call it, and not applicable again on banks and financial institutions. There is a specific interest deduction rule also, which we do not have in India, and it is a little unique. And I would say, again, a game changer or a master stroke or beauty of law makers, that the way they have drafted it is amazing. So that's the last point. It says, if you have obtained a loan from a related party and you are using that loan either for dividend distribution, capital reduction, making a new capital contribution, or acquisition of a new company or an ownership interest of another related party, or once you acquire that, it will become a related party. So A has given a loan to B. Let's say, distributes dividend to C. A, B, and C are related parties as per the definition of Article 35. So the interest that is being paid on the loan given by A to B will not be deductible. So it is a specific interest rule, interest deduction limitation rule, which I don't think I've seen anywhere else. But then it actually plugs in tax leakage. How? You can see that if A gave a loan to B, B invested in shares of C, all of them are related parties. C distributes dividends to B, and B is taking a participation exemption, paying no tax on the income received, but then is taking an equivalent tax deduction of the interest being paid to A. So here at one end, you didn't pay tax on your dividends because you took participation exemption. On the other hand, you are taking a tax deduction also. So everyone is losing in such a scenario. So this is an amazing rule that has been brought in for a specific interest deduction to limit the specific interest deduction. Going on, another great concept of tax grouping that we do not have in India, but it is present internationally in various European nations. That in India, we consider every taxpayer as a separate SSC or a separate legal entity or a separate entity to pay tax, right? But in UAE, there is a provision of tax grouping where it says that if you hold 95% of the voting rights, share capital, and profits, then you can group your entities, provided there should be a holding subsidiary relationship in UAE. We'll quickly take a look at the conditions of tax grouping over here. In the first triangle, it talks about the 95% condition that I've mentioned, that it should have 95% share capital, voting rights, and profit distribution, or right to get 95% of the profits. And this relationship should be between a parent and a subsidiary. All of these entities must be resident, follow the same financial year, follow the same accounting standards, and prepare the FS for the same accounting period. So that is the same financial year. None of these could be a free zone person or taxed at 0%. And as I told you, that there is a holding subsidiary relationship. So let's say, and all of them have to be juridical person. So me, let's say I am a natural person resident in UAE. I have 6 companies that I own shares in. I cannot do tax grouping. The reason being, I am not a juridical person and there is no holding subsidiary relationship. Let us assume I, as a natural person, I hold shares of company A. A is a holding company for all my business verticals, let's say logistics, ports, shipping, door-to-door logistics. 5 companies, shares of 5 companies are held by A and I hold the shares of A. So A and those 5 companies can make a tax group and be considered as a single taxable person. But again, the basic threshold of 375,000 dirhams is not available for every entity. It will be only available once. So it has to be seen, a cost benefit analysis has to be done to see whether you will actually save a lot of compliance cost. And then again, from transfer pricing perspective, because your intra-group, at least your domestic intra-group transactions will be cancelled out because you will make a consolidated financial statements. And these consolidated financial statements need to be again on IFRS or IFRS for SMEs. So there are a lot of benefits to forming a tax group, but then downside is that you lose the basic threshold of 375,000 dirhams. And I would say it's just number of entities into 9% of 375. So I would say a detailed cost benefit analysis should be done before going for a tax grouping. To go for a tax grouping, right now, all the entities need to apply for a tax registration number and then apply to become a tax group. And then the parent entity is responsible for doing every compliance that in our case is the final return. But all the entities are jointly and severally liable to pay the taxes on the income that have been on the income that is taxable. So if we quickly look on what actually happens or what are the implications, is that first we prepare the CFS. They will jointly pay the tax, treated as one taxable person. Right, the threshold of 375 will be available only once. But any company is free to leave the tax group when it wants, but whenever it will happen, it will be from the beginning of the tax period, either in which you apply or the next one. And similarly, there are provisions to join. So it's not a all or none approach. Let's say you want to make a tax group right now only for 5 of your group entities and you leave the other 3 out of the tax group. That is completely fine. Those 3 will be taxable as separate legal entities. And I don't think there's a problem right now for that. And you can still obtain the benefits of tax group at a particular part of your complete group. So that is okay. So it's not an all or none approach. So if you want, maybe after 2 years, you want that these other entities also become a part of your tax group, yes, you are free to do that. Or you want that, oh no, tax group is not being so beneficial for certain entities, so the current two entities also want to leave the tax group, yes, make an application and be the guest of FTA to leave the tax group. So that is completely fine. It's not out of bounds. It is nothing very new. But again, I would say that this provision of tax grouping will be a very big blessing for big groups who have multiple entities in the UAE and suffer with a very high compliance cost. So again, it is a benefit for those groups as well, and not just small businesses over here. So what would you say that what will be the benefits of tax grouping? One is very clear, that losses of one entity will be offset with the profit of others, because you will consolidate the financial statement. So you will be taxable as one entity and these losses will be set off. So you will not, you will actually pay tax as an ultimate beneficial owner as on your real income. In India, what happens is that I have 5 companies, 2 are in losses, 3 are in profits. And at last, like the net, I am still in loss. And we are still paying tax on the profits that we have earned in the three entities which are in profit. So this is a challenge which has been mitigated again over here, and this shows the proactiveness and the message that the UAE tax authorities wish to send. And again, as I told you, that the TP provisions will not apply because your domestic transactions will be set off from each other or cancelled out. But again, your cross-border transactions would be there, and they will still fall under the ambit of transfer pricing. I think there is little time left, so I'll skip on this part and like the few not so important things that have happened, and jump to the transfer pricing provisions, because I would like to spend some time on that, because I told you it is something that a lot of professionals are looking at as potential business. And also it's a great area to practice in general, not just in UAE. And the good part about it is that it's standard pretty much, and you will see reference to OECD guidelines. So the reference has been made to OECD guidelines in the explanatory statement, that wherever you need more additional guidance, go to OECD transfer pricing guidelines of 2022. So we'll take a quick look on what is the applicability and what are the substantive provisions of transfer pricing in the UAE. So we all know on what is transfer pricing right now. When two related parties are transacting on a commercial transaction, it needs to be on arm's length. What is arm's length? Arm's length is a condition wherein your relationship doesn't affect the pricing of your transaction. Basically, if I'm selling a mobile phone to my sister, the relationship of my sister and me should not affect the price at which I sell her the mobile phone. It should be the same as I sell it to, let's say, Piyush sir over here. That if I sell it to him, it should be the same that I sell it to my sister. So if that's the case and the condition and the price are the same, so we are at arm's length. If you see the Indian, or if you put the Indian TP regulations in comparison with the UAE ones, I would say that the coverage of UAE regulations is more. Reason being, in India, for transfer pricing, only international transactions between related parties are covered. But UAE says any transaction between related party and connected persons. Again, I'll point out the difference between the public consultation document and the final law. In the public consultation document, it was just talking about international or cross-border transactions between related parties. But when the final law came in, it consists of the wordings that all related party transactions and transactions with connected persons need to be at arm's length. So even domestic transactions would be covered. And we would see that few domestic transactions are tax neutral, few are not tax neutral because of the presence of two things. First, a free zone. And second, the basic threshold of 375,000 dirham. So this is there. Looking into detail, these are the 4 articles which in combination are called the TP regulations of UAE, Article 34, 35, 36, and 55. 34 is the basic principle or the arm's length principle. It states that all related party and connected person transactions need to be at arm's length. It tells you the methods for benchmarking, but does not give a lot of detail, but it says you need to be at arm's length and defines what is arm's length principle or arm's length price. Article 35 defines who will be a related party and what is the definition of control. This is one of the most important thing again in transfer pricing space, because any which ways to establish to establish that you are under the TP regulations, first you will have to establish the relationship between parties is of related parties or connected person as per Article 36. Connected person, the concept of connected persons is a little unique to UAE, considering that there is no individual level taxation right now for employment income. So it has tried to plug that loophole as well, or that area of tax leakage as well. Article 55 purely is concerned with TP documentation. We will see what are different types of documents that needs to be maintained and what type of disclosure needs to be filed and not just maintained. So it's just an indicative list of transactions or types of transactions that you can do with your related parties. That includes goods, services, financial arrangements like loans, guarantees, corporate guarantees. Then you have intellectual property payments, royalties, license fees, cost contribution arrangements. Then you have global recharges or reimbursements, as we call. Then transaction with connected persons. Or again, you will have domestic transactions which might not be tax neutral. So a transaction between the mainland and a free zone entity. This is the complete coverage broadly of the transfer pricing rules that you see. First, the transactions which are happening in the domestic, or let's say in the UAE. So transaction between a mainland and free zone, transaction between the mainland and mainland. All of these are covered under the transfer pricing ambit, provided that you are a related party or a connected person. Cross-border transactions, irrespective you are in mainland or in free zone, both of them are covered. And then the unique concept, the new baby in town, that is connected persons. So payment to connected persons are again also covered. So seeing the definition of related parties, it has been divided essentially into three parts or three relationships, we can say. First one being a relationship between two natural persons or two individuals. Second one being a relationship between a natural person and a juridical person. And third one being a relationship between two juridical persons. So when we talk about the first tier of the relationship, that is relationship between two individuals or natural persons. So you would see that it is so broad and deep at the same time, because it is covered till fourth degree of kinship. You can see certain examples on the right. So if it is me, so my related parties here would be my parents, my grandparents, my great-grandparents, and my great-great-grandparents. Similarly, for my great-great-grandchildren. It would also cover my cousins, like my father, first degree, my father's brother, second degree, their children, third degree. So we are still left with one more degree of kinship to go beyond that. So it is like equally deep and broad when you cover this. And considering that a lot of businesses are family owned in UAE, this would be a major setback or a major barrier when analyzing who the related parties are. When we were in school, or let's say in the primary classes of grade 1 or grade 2, we used to make a family tree. That is the reality now for transfer pricing rules. That who is the owner, he'll need to give not just the group structure to you, but his family tree also to determine who all are related parties. So this is reality now. Going on to the next level of relationship or next tier. Next relationship was between a natural person and a juridical person. Let's say an individual and a company. So it says if this person, either alone or with its related parties, own 50% or more of the company, then they are related parties. Or control the company, then they are related parties. So on control, there is no percentage that has been assigned. What is the meaning of control? That has also been defined, and we'll see that. Similarly, a relationship between two juridical person or two companies is of 50% of ownership, either alone or with any other related party. Then going on, that if a same person has participation in two companies, so let's say A owns 60% of B and also owns 60% of C. So B and C will also be related parties over here. So it is comprehensively and extensively covering the relationships that one could actually imagine in a corporate scenario, also in a personal scenario. Then going on to few specific examples, they have said partners of unincorporated partnership, a branch and a PE of a taxpayer, exempt and a non-exempt business. So if you are an exempt person where you are not paying tax, and then you have a non-exempt business where you are paying tax, these two will also be related parties. Transactions between them needs to be on arm's length. When we have read control, so control is usually like appointing board of directors, having ownership again, or being part to the core decisions of the company and not just the administrative or the day-to-day decision making. If like I am the head of the family, I am not an owner in any of the companies, but all my family members don't do anything without asking me. They do not even appoint an accountant without taking my approval. So I might not be the owner of those companies, but for sure, if put on paper, I have the control of those companies. So control is way different from when we look at control and ownership. Going on to Article 36, and not taking a lot of time here because we have to wait for the Q&A also. So Article 36, the unique concept, or as I termed it as new baby in town, is connected persons. Who are connected persons? It said the owners, the directors, their related parties. So if you are making a payment to your director, it needs to be at arm's length. I'll be like, oh, I am the owner and the director. I am making payment to myself from my company. And you will tell me that it needs to be at arm's length. I'll not do it. Okay, don't do. No problem. It's just that you will not get deduction. It will not be deducted from your taxable income. Irrespective, you have taken the money out from the company, you will still pay tax 9% on that. So for connected person payments to be tax deductible, there are two conditions. First, it needs to correspond with the market value of the service. So as a director, if I am giving a service to a company, it should correspond to the market value of that service. Basically, should be on arm's length. Stating it in the terms of a transfer pricing professional, the payment should be on arm's length. And second, it should be incurred wholly for the purpose of business. It should not be in the nature of a personal expenditure. Only then you will get a deduction of it in the taxable income. It is fine. Then you will say how to benchmark or how to see it is on arm's length or market rate. There are few conditions like your qualifications, your previous job experience, what exactly you are doing in the company. You should not be a dummy director. Or, today you are taking a salary of 100,000 and now, from next year, the tax is being introduced, you increase your salary to 10 million. So all of these things will be caught under the crosshair of either GAR or TP regulations. So be careful wherein you are changing payments or changing the terms of payments to connected persons. I think this is the last one that we'll see is about the TP documentation. So for documentation, there's a 3-tier approach that's suggested by OECD. Everyone knows it. A local file, master file, country by country reporting. Country by country reporting was already introduced in 2019 when UAE signed up for the BEPS program and they said, okay, we'll do everything necessary. Local file and master file have been brought in now. We have discussed the decision that talks about the threshold of 200 million or being a part of an M&E group. But there is another thing, that is the disclosure form. Closest relative will be Form 3CEB in India. That is the TP audit. So that disclosure form should be filed with your return of income every year. You will ask that whether the form is out. No, the form is not out. The contents of the forms are not out. The contents of the local file and master file are also not being disclosed or clarified yet. We are waiting for it. And as soon as it clarifies, a lot of things would come into picture on what needs to be disclosed and what not, what types of transaction need not be disclosed even in the disclosure form, because there are certain carve-outs from disclosure in the local file, like domestic tax neutral transaction need not be reported in the local file. But whether they would be required to be reported in the disclosure form or not is still in there. I would like to reiterate again over here what I told you when we were discussing about the local file threshold or master file threshold. That no matter you do not cross a threshold and you do not have to maintain a local file. No problem. No one is asking you for a local file. But then you need to keep enough documentation to prove that your transactions with related party and connected persons are at arm's length. And to know that they are on arm's length, you will need to do benchmarking process as a whole. Keep it in as formal documentation. So it's fine. Don't make a local file. That's okay. But then as per Article 55, FTA can still ask you to present your proof of an arm's length transaction, even though you are below the threshold of maintaining a local file. This is a quick timeline. Everyone must have seen it. Ministry of Finance has posted it publicly. So for businesses that operate in a calendar year, the first year would be January to December, having the first return filed by 30th September. So you can obtain a tax registration whenever you want before the return filing period ends. This is a quick action plan for businesses that operate in UAE. First, do an impact assessment, see how the provisions of corporate tax and transfer pricing are impacting your taxable income or your bottom line for that matter. Recalibrate your corporate structures. If you have made a mess in UAE, opening, let's say, a bundle of entities, few are operative, few are non-operative, and the books of accounts are not maintained properly and financial statements are not being drafted properly. So first, regularize that. See where you can do tax grouping, see where you can take small business relief, see that where you are eligible for a free preferential regime in free zone. And third point again over here for related parties, why I stress so much on related party transaction, because I gave that reason before. UAE is a house of family owned businesses. So in a family, everyone will be a related party. You have seen how natural persons can be related parties. So it's a house of family-owned businesses. So transfer pricing is one area where you need to be very vigilant. Irrespective of any threshold they bring in, you should transact at arm's length. To transact at arm's length, do benchmarking process. Don't consider benchmarking as a cost. It is just a value which will help you save millions in penalties later on. Transfer pricing defaults are one of the highest penalizing defaults in the Indian tax law also. And probably something similar would be there in UAE because it is there to solve a very big problem of tax leakage and base erosion. And I don't think any country would want to lose out on that revenue. So, sir, from my side, this is it. Open for questions, your remarks. Correct me if I was wrong anywhere, and open for everything.
Thank you very much, Rishabh. Thank you. A very extensive presentation, I would tell. There are a lot of remarks, a lot of questions. Obviously, I've tried to consolidate, and when I read the questions, obviously, a lot of you would have answered. But obviously, for sake of further clarity, I would put before you. Of course, a lot of participants has also requested and also has made comments that it was a beautiful presentation, and they would like to have your presentation. So obviously, my office will seek your permission if we are able to share with all the participants on the email. We'll definitely share. Rishabh. Rishabh, now I'll directly come to the questions. Already we are at 8 o'clock. Our time is almost there. So I'll take 5 or 6 important questions. Some are quite basic, but I would not like to leave it and you have covered. But for the sake of repetition also, I think so I need to cover that, considering. A very basic question that is coming is, what about taxability of entity in FZE? Are they fully tax-free?
Sir,
Free zone enterprises.
I think no problem in repeating it. but
Yes.
it's not very clear on what part of income of a foreign sort of free zone person will be tax free, or let's say taxed at 0% or not. We really need to wait for two decisions which would clarify the definition first of adequate substance or substance, and second one, what is the qualifying income? Because I read that sentence verbatim that qualifying income of a qualifying free zone person will only be taxed at 0%. So first you need to have a qualifying income. What is qualifying income? No one knows, sir.
Right. So that was the another question, which was again a fallout of that. That how would be the qualifying income and non-qualifying income will be identified? And there was, of course, as you said very rightly, it's not currently identifiable what would be the qualifying income. But let's take an example. We get a clarity in a week or two, basically, or maybe in the future course, whether they should be, whether one of the participants wants to know whether they should maintain separate books of accounts for this, for qualifying income and non-qualifying income.
I'm not very privy with what IFRS says over here, but I would say for clarity perspective, even if you do not have separate books of accounts, you can have a segmental financial statements. Because at last you would be calculating your taxable income from your accounting income or accounting profit. So a segmental financial statement would be of very big help. As I told you, tax compliance is the consequences of good financial reporting. So at first we need to do good financial reporting to arrive at a proper taxable income.
Yeah, Rishabh, I believe obviously the separate books has been asked because there would be a common cost also. The direct expenses can be reduced from the qualifying income, qualifying expenditure. But there would be the common cost, and that allocation may be also required. And I believe that was the perspective from which the participant then asked. So as I appreciate that it should be separately identified, whether you have a separate books or you may have a segmented reporting for the qualifying income. That's what I appreciate. Kishanji, you would like to come in?
Yes, sir. I would like Hari sir to add on this, sir.
Yeah, I think this is very clear. I mean, when you are having a company code or a one company license, then you have to maintain only one books of accounts, and you can always have your profit center defined as free zone and mainland, and then you can capture qualifying and non-qualifying income separately in ERPs. I mean, even basic ERPs are given this facility, so that's not an issue at all.
Okay. Coming to another question, which is a legal more, obviously, what is the difference between executive legislation and decree law?
Hari sir, please, sir.
Hari sir, can you please come in?
No, this is very clear actually. See, whenever there is a decree being issued, then that decree is being issued by the actually royal families. And the executive regulation is being issued by the Federal Tax Authority. So this is the difference. Decree is always signed by the royal family member. Okay, and then it will be effective with whatever date they mention, and then the executive regulation is created based on that decree. This is how it is in the UAE.
Sir, just to add one small thing to add, sir. The decree at every place has mentioned who has the power to give another legislation, either the cabinet, Ministry of Finance, or the FTA, that is the Federal Tax Authority. Okay. So it has been clearly mentioned in the decree, and the power has been delegated downwards on specific, let's say, limb of the government or the legislature.
Right.
Okay, thank you very much. Another question is, I believe it's from a transfer pricing angle, Rishabh. How will be benchmarking for interest be done? In India, we normally use RBI ceiling rate as a base or a PLR. Will UAE require a credit rating analysis to be done something? So what would be the benchmarking for the purpose of transfer pricing in UAE?
Couple of ways to benchmark interest or let's say financial transactions. One is that you can download the actual agreements from the databases. There are databases which have actual loan agreements. So you can download as per your terms and conditions, and you can see whether you are at an arm's length or not. Most of these agreements were based on LIBOR, which has been discontinued, and an alternate reference rate has been introduced since June. So this needs to be changed, but yes, reference can be made. Second is again open market rates. That at what rate locally you could have obtained from a third bank. Checking at the flip side, you could see the entity giving the loan, what return it is getting, what it would have got if it would have invested in the risk-free, or what is the risk-free rate of return. As of now, there are no safe harbor rules for intragroup financing in UAE, but we expect more clarity to come in because safe harbor rules cannot be generalized. They are more of personal in nature, that what exactly the jurisdiction wants. So we would see, because right now for TP guidelines, we are directly thrown in the direction of OECD guidelines. So, I mean, there are a couple of ways to benchmark interest transaction, and nothing that it is not possible. Yes, it is possible with the right access to the right databases. And you really need to do first functional analysis to see what method you will apply to benchmark that transaction.
Any suggestion on database, basically, to be used for transfer pricing benchmarking in the UAE? Like
for every transaction, like for, let's say, for manufacturing, service, trading, or let's say active businesses, we have TP Catalyst or S&P, one database from S&P. Then for IP transactions, we have Royalty Stat, Deal Scan, Loan Scan. Like there are a couple of databases that are available. I would say bundle of them, not even a couple of them. And all of them should be equally acceptable, because there is no stand right now as of from the FTA that what is an acceptable database. But again, as I told you, that due to the opacity in UAE, that the data is not available from UAE perspective, because the filings are not being made. The problem here is that you have to expand your search going beyond UAE, going to either to Middle East or to Eastern European nations in order to have like a scientific benchmarking process.
Okay, thank you very much. Harikeshan ji, if you want to add any point of this time, you please do add.
I think no, this issue still remains, I think, and there is a discussion going on. So maybe we will get further more clarification by way of cabinet decisions at the end of the day. I mean, how the benchmarking marking will be done. So as he mentioned, I think maybe we can refer to some other countries like maybe Singapore, Mauritius, or any other country for that matter. And we can take the benchmarking from those countries, because here most of the businesses, big businesses, are owned by the family offices, and they are not declaring, or they are not submitting their financials to the, so data is not available locally. But yes, it can be taken from the other countries, I mean, as I mentioned you.
Rishabh, there are 2 or 3 very basic questions. I believe, of course, you would have covered, but at the sake of repetition again, should we obtain TRN for a UAE incorporated company if income is below the prescribed threshold?
Yes, sir. Everyone having a license should obtain a TRN, sir.
Achha. And if financial year is April to March, when is the first return filing period?
There are 9 months ending from March. That would be in December 2025.
Okay, so for April to March is my financial year. So my first will come in December 25 or yes, December 24.
25, sir. April 24, your financial year starts. March 25, it ends. 9 months from March 25 is December 25.
Okay. Yeah, so it will be 31st December 2025. Yeah.
Yeah. So even if, as you said, that if below 375 also I should take a TRN, then obviously I will have to do voluntary filing or declaration will be required to be done in that case.
So I don't think that is very clear. Hari, sir?
Yeah. No, I mean, see, as Rishabh mentioned, that if this is a legal company and they are having a valid trade license, then they have to register for UAE corporate tax. They have to submit their financials and they have to submit their corporate tax return within 9 months from the end of their financial year. So all the companies have to do it. I mean, it's irrespective.
Okay. So if I fine. One more question. In case of an Rishabh, I think so for you, in case of an Indian resident is the partner in a partnership incorporated in UAE, will the share of profit taxable in India? Obviously, this is from Indian perspective, not an UAE perspective. But I thought I'll just put up to you.
Sir, for domestic law, please consult Chairman DTC, sir.
Suggest, sir. Agreed, sir. is there any difference in tax on companies incorporated in different free zones like RAC or Jebel Ali or whatever it is? Free zone is free zone, or there will be something different?
Sir, all free zone are equal, sir.
Okay. Last question I will take up because there are many, and they are still coming up. When I'm speaking, the questions are still coming. To transfer tax loss between the entities, one is having 75% ownership interest in another. Is that mandatory to form tax group?
Sir, for tax group, the condition is to holding of 95%. Transfer of tax loss is only in a tax group. 75% condition is for transfer of assets.
Okay.
So, sir, it's a bigger condition to form. It's a tougher condition to form a tax group.
So I need not mean to say if I have to transfer the tax loss, whereas there is a 75% ownership interest, I did not mandatorily form a tax group.
Sir, I'll just quickly go to this slide where it was mentioned. The transfer of loss is with 75% common ownership. But to make a tax group, you need to have at least 95% of share capital. So it's a tougher condition.
Yeah, Rishabh, this is another advantage actually. See, if you are not holding 95% and if you are having a common ownership in various companies holding 75% or more, in that case also you can transfer the losses.
Yes,
so
sir.
This is another relief actually which you have received.
Yes, you do not need to form a tax group to transfer the tax loss.
Yes.
Okay. Okay. Thank you very much, Rishabh. Last question I'll take a very basic. It's in regard to proper understanding of MD number 73. Small business relief threshold will apply for the first year of 2024, January to December revenue, irrespective of the previous year 2023 revenue, as it is not a tax year for that entity.
I think it has mentioned that it is only applicable to 31st December 2026. But first should be considered your first tax period, that if it is from January 24 to December 24, so that should be considered, sir, as the first tax period, and the revenue of 3 million threshold shall be considered for that particular year.
Okay. Thank you very much. I've tried to consolidate all the questions. Obviously, they keep on coming, but we are already gone ahead of the time. Chairman sir, would you like to come in? I think so. He's in the council meeting. Okay, sir, he can't speak. A very big agenda is going on. So he has given my duty that you please close this, address this. So thank you very much. Harkishan ji, would you like to come in? Any concluding remarks, sir, as a chapter chairman?
No, I think it was a very nice presentation by Rishabh. Really, I'm impressed, and he has covered all the aspects from A to Z. Including all the cabinet decisions, FTA decisions, and whichever has already been introduced recently. So it was a great learning for me as well. I mean, you always tend to learn new things whenever there is a question from the members. So all in all, it was a great session. Thank you very much for inviting me, and thanks to you as well as to Chairman Sanjay ji. Thank you, sir. And I'm available at your disposal anytime.
Sir, now it's my job to propose on behalf of Direct Tax Committee of Institute a vote of thanks to my senior speaker, SP Singh sir in his absence, and Rishabh Agarwal. Rishabh, beautiful presentations. There are so many messages are coming. A very detailed presentation, I would say. Please, of course, I will thank you very much for also allowing us to share with the participants. We'll do that, and we will also plan. I'll speak to Harkishan ji. A physical session hona chahiye aapka Dubai mein, sir. I'm sure Rishabh.
Always.
Harkishan ji, unko
definitely we'll take it up, sir. We'll definitely do it. In the past, I think Rishabh has already done on the transfer pricing in the workshop. But yes, at a bigger scale, we will definitely invite him.
So अभी जब हम physical course launch करेंगे तभी उसी time पे कहीं ना कहीं ऋषभ जी को invite करेंगे. ऋषभ जी, we'll take your time and we'll fix it up. ऋषभ, we'll do something on that. So thank you very much. Thank you, my chairman sir. He cannot speak. He is in the council meeting.
Sure.
Thank you very much, and thank you, chairman ICI Dubai chapter and also Abu Dhabi chapter in absence. Thank you all the participants for your patience. Thank you. We'll end this session.
Thank you, sir. Have a nice evening. Bye bye.
Thank you, technical team.